So after a brutal week for markets, we're going to discuss why it feels as bad as it does, what history tells us what might lie ahead, and the mindsets we need to embrace to get there. So what was behind this week's brutal sell-off? Well, a disappointing consumer price inflation reading came in, leading people to believe the Fed may have to be even more aggressive than had been previously feared. And so again, out come the doomsayers, out come all the experts that were nowhere to be found before this. Just lots of doom and gloom everywhere you look. Starting with the inflation picture, why is it maybe not as bad as you're being led to believe? Well, first of all, just the simple idea that things do not move in straight lines. They do not move evenly, but the totality of the evidence is inflation is continuing to retreat. CPI actually dropped month over month. The core reading increased slightly, but perhaps even more importantly, the producer price readings actually exceeded expectations to the downside. Why is this so important? Well, producer prices are the leading indicator for where consumer prices are likely to be moving forward. Furthermore, a lot of subcomponents that have been fueling this inflation reading are now weakening, whether that's continued improvement in supply chain, severe cooling within the housing market, energy prices that again are still declining and or stabilizing, all mean that things should continue to improve moving forward. Furthermore, monetary demand, the M2 supply, continues to both abate and draw down. That's, again, the thing that nobody likes to talk about in the press. We've been harping on. That trend continues intact. Lastly, even for those who fear inflation may not slow as quickly as we need it to, here we are, probably near peak hawkishness. Again, about as dire of an outlook as to what the Fed may do. And it only led to about a 25 basis point increase in expectations, which in and of itself may not give markets the green light to shoot higher, but likely means with this market's reading, again, we're putting in this floor that we've been looking at around the 3,500 to 4,000 level on the S&P. Second point, why does it just feel as bad as it does? Well, for one thing, we are at a record level run in volatility, i.e. weekly moves of up or down 1% for the markets. This is just the 12th time in history we've had what is now 6 consecutive readings. And those times, it's worth noting, always come during times of a lot of doom and gloom, a lot of dire headlines. This isn't different. And those that believe, oh, this time it will be different, again, that's been the beginning of a lot of sentences that end with looking foolish. When are some of those other periods? Coming right off the heels of the 73, 74 recession. You can see the chart we've put up for you here. The 1990 savings and loan crisis and corresponding brief recession, 01's dot-com crash, the 2003 recession, 2008 great financial crisis, 2020 global pandemic. Point is, those times were scary. Certainly there's some tough times here, but what comes next is really the question that people should be asking. And here, we're going to throw up another chart. You'll see the totality of the evidence of all these different periods is things will get better. Again, 1 and 3 months later, the median performance of the S&P is up 4.4 or 5.51 respectively. If you look 6 to 12 months later, the average performance is solidly in the double digits with positive returns 80% of the time. So is that a prediction or a guarantee about what's ahead? No. But when people say with a conviction on the other side, oh, it can only get worse, it's only going to go get down, this time is different. We've never been here before. It's just simply not true. And the evidence, the totality of the evidence, history is simply not on their side. So what does all add up to? Point number 3, fade the crowd and the experts. Currently, a Yale study that we've cited in the weekly written portion of this weekly commentary shows that retail bearishness is at a 20-year high, not seen since the 2001 meltdown, and again, post right after 9/11. On the flip side, and again, we detail this out in the written part, the economy is staying pretty resilient. That evidence of, well, how will things ever bounce back? What could go right? If you look at the economy, you still have a resilient labor market. I know that's partially bad news for the people worrying about inflation, but the lack of cratering there is ultimately a strength. 2, manufacturing just put in some record levels. Retail sales continue to be strong. all of which means that yes, we're certainly taking our lumps within the market as investors, within the economy in general, but that resiliency, that ability to bounce back that we're counting on showing up in time, still plenty of evidence for that. So what are some key takeaways? 6, 12 months later can feel like an eternity in the midst of weeks like this. Well, a few things. Number one is just, again, get framed around, don't get hung up on the scoreboard. How many things in your life are you getting a daily accounting for how it's going? Whether that's a relationship, your job, the value of your home, and the answer is you don't, right? You put your time and attention into the actions that you hope will inevitably lead to the relationships, the career, the portfolio you want to see. So don't let the fact that you get that intraday accounting within your portfolio get you too fixated on what every little move, every little bit of noise might mean. Oftentimes, again, it's just noise, not a signal. Point number two, what the market's going to do in terms of the realities that lie ahead are far more about the expectations of those realities than the realities themselves. And there, the good news is expectations are horrible. So anything less than horrible actually will lead the markets to respond well. Number three, you need to build portfolios. Certainly we build portfolios not just for the good times, not just for the exciting things that manifest in a portfolio over time, but for these tough times. It's why we talk about volatility protection and diversification. It's why we talk about income generation and really focusing on that, which leads me to, again, shifting your mindset from just one of stacking cash in that proverbial shoebox that you're going to then pull from into buying income producing assets and focusing on that cash flow and finding sources that can be durable throughout market cycles. This is what we're doing, which leads me to my final and fifth point. We are not weathermen. We're not here to try to predict the weather. The way we successfully build those portfolios, get you that cash flow, is all about understanding that our job, again, is not to predict the weather, but to help you safely navigate the inevitable storms that are going to happen within the life of an investor, get you safely to that other side. And again, that's all about sound planning and portfolio construction. So seasons are changing. This market season, this chill that we're experiencing in the markets, it will pass too. Again, the key is to keep your spirits up. Know that a new season will be upon us. And in the meantime, make sure your portfolio has that proverbial coat around it to keep you warm until we get there. As always, thanks for watching.